Hey everybody, Adele Foltz here, your professor for Accounting 1, and welcome to your next installment of your Dollars Make Sense video on the accrual basis of accounting and adjusting journal entries and what they are, why they're necessary, and other good topics from this chapter. So let's talk about the cash basis of accounting versus the accrual basis. So we have cash basis over here on the left and accrual basis over here on the right. So on the cash basis, if we are accounting for our entity on the cash basis of accounting, it's a real thing, then we have revenue is recognized when ... I'm going to complete this, when the cash is received. So if I were to provide landscaping services today to my client, but I'm going to send them a bill when I get back to my office, and they're going to pay me next month, I would not have any revenue this month. I would have revenue, even though I performed the services this month, I would have the revenue next month when the cash was received. Under the accrual basis, we are not concerned with cash at all. Our revenue recognition principle says, now your book actually goes through a series of steps, and as you study accounting further, you will become more familiar with those steps and use them. We're going to keep it quite simple in Accounting 1, and we are going to say that revenue is recognized when it is earned. And by earned, when it is earned, it means that we have satisfied the performance obligation, whatever it is that, our performance, the performance that we were obligated to provide to our customer. When we have completed that performance obligation and we are entitled to the revenue, that's when it is earned. And so that's when we're going to recognize it. And by the way, when we say recognize, we're talking about recorded. That's when we're actually going to record the revenue. And so under the accrual basis, we're going to recognize revenue when it is earned. In Accounting 1, we're going to keep that quite simple and say that it is when the services are provided or the goods are provided to our customers. Okay, so let's talk about expenses then. So again, under the cash basis of accounting, that expenses are going to be recognized when they are paid in cash. So it's going to follow the cash. So if we paid our rent for next month, if we paid it this month, we would have an expense in this month. Why? Because that's when we are using our cash and paying for it. And so again, the expenses follow the cash. Under the accrual basis, expenses are recognized. We've covered this already in an earlier chapter. It's actually kind of a two-pronged principle, and we say expenses are recognized when they're incurred. Okay, so we do not wait until the expenses are paid. If we have incurred that expense, and we also talk about the matching principle. So we've incurred the expense in order to generate revenue. We want to make sure that we match the timing of recognition of the expense, match it with the revenue that it generates. So if we are recognizing the revenue, we should also be recognizing the expense. Okay, so it's kind of two-pronged, and we'll talk about it both ways. So the question is, which of these two methods actually represents Gaap? So there is no question at all. You should actually already be able to answer this for yourself, that the accrual basis of accounting is Gaap. The cash basis is not Gaap, and we are learning Gaap in this class. So we are learning the accrual basis of accounting. One of the reasons that the accrual basis is our GAAP, generally accepted accounting principles, is that it's much less susceptible to manipulation, right? So if we can manipulate over here when we receive cash or when we use our cash to pay a bill, we can actually manipulate our revenue and our expenses and therefore our net income. So, the FASB doesn't like that. None of us should like that, really. We don't want to have companies manipulate their net income. So over here under the accrual basis, we are going to recognize revenue and expenses in the period where the event occurs, right? Much less susceptible to manipulation. And so the accrual basis is absolutely GAAP, no question about it. So my question is, why should we even be discussing the cash basis if it's not GAAP? And we're going to spend all semester talking about GAAP. So why should we even be discussing this? Really, because there are lots of small businesses that use the cash basis of accounting. So, and it can be an acceptable basis as long as your receivables and your payables are not material. So if you either don't sell on credit and don't buy on credit, then you don't have receivables or payables. And then the cash basis and the accrual basis, there really isn't much difference if it's fee for service. If I provide a service for you, I get paid on the spot, there's not going to be any difference really between the revenue recognized when the cash received and when it's earned, because I'm going to get paid when I provide the service. So as long as the receivables and payables are not growing and they are relatively small and immaterial, then we can use the cash basis of accounting because there just isn't much difference. The other thing is that oftentimes small businesses are using the cash basis of accounting because, number one, it's easier. As long as they don't need to prepare audited financial statements, and audited financial statements actually say that the financial statements are fairly presented in accordance with GAAP. So if you need to have, if your investor or your creditor requires audited financial statements, then you need to convert to the accrual basis of accounting because they will not accept the cash basis, especially if those receivables and payables are material. So you need to record on the accrual basis of accounting. So, but again, you may have some small family businesses and they're using the cash basis. I don't want anybody running home and telling mom, dad, aunt, uncle, sister, brother, whoever, that they are not recording and keeping their books properly. So understand that, there are still many businesses that use the cash basis of accounting, and they usually disclose that they're not intending to use the accrual basis. And again, if they're not being audited, that's acceptable. Okay, so we came from some chapters where we talked about the accounting cycle and we identified transactions and we recorded them. And then we posted them, and then we prepared a truck balance. And our period assumption says this: we can take the life of the infinite continuous life of a business entity and we can divide it into periods. So sometimes the period is a whole year, or sometimes it's a quarter. So a quarter is 3 months, right? So this would be the quarter ended 3/31 or 6/30, 9/30 or 12/31. If we were dividing it into quarters, or we could also divide it into months. And we could have 12 months. And so this would be for the month of January. So this would be 3/31 and 2/28 and so forth. So the period assumption says we can divide the life of our entity into periods, and that we should actually do that and report to the outside world what happened during each one of those periods. So we have these adjusting journal entries because of this assumption. And if we, I'm going to erase this for a minute. Whoops, wrong thing here. So what's happening is if we're reporting monthly, right, and this is January, we have some transactions that affect both January and February. Okay, let's talk about, well, let's talk about season ticket holders for a sports team. So it may be that that we, our customers, right, our fans, buy the season tickets before the season even starts. So you know, I don't know. Let's see. I'm not sure. I guess this could be baseball, maybe. Let's say this, that the season ticket holders pay for their whole season tickets. They pay for it here in January. They're required to pay for it up front. So so the franchise actually has the cash. The question is, does it have the revenue? The answer is that it doesn't have the revenue, but once it starts playing games, I guess that's going to be out here, maybe in March or April. I'm not too familiar with the baseball season, but let's see, so this is January, February, March. Let's say they start playing some games in March after spring training. So this is 3/31, and this is the month of March. So now when they start having games and you get to go to games, the customers, their fans get to go to games, here's where they start recording the revenue. And they're going to continue to record some every month until the season ends. And so the cash was received all the way back here in January, but the revenue is going to be received every time we have a home game that our fans attend. So again, what we have is that we have a transaction where we have recorded the cash in January. That was the subject of an earlier chapter. And what we did in that case is we debited cash because we received cash, and we credited unearned revenue. We said that was a liability. Crediting it makes it go up. And it's not an earned revenue because on January 15th, when we received this cash, we have not had any home games yet. The season hasn't even officially started. And so we have a liability where we need to either play those games and provide seating for our fans who bought tickets, or if for some reason we don't, then we certainly owe them the money back if we can't, you know, if we can't continue our season. So, and of course, COVID would have been a good example of that type of scenario. Okay, so so what we need to do is we are providing financial statements as of 1/31, and we need to make sure that in January, we're recognizing all the revenue and all the expenses for January that are in agreement with our Gaap principles up here, our revenue recognition principle and our expense recognition principle. So, so we are recording transactions all month long. I'm going to erase this here a minute. All month long. And now all of a sudden, we have to issue financial statements at the end of the month, and we need to make sure that all of our revenue and all of our expenses, if we're going to issue a financial statement, that on our income statement, it includes all of the revenue and all of the expenses for this month. And that equals net income. That's our income statement. And then we also want to make sure that on our balance sheet, all of our assets and our liabilities are correct. So let's talk about how we actually do that. So we have adjusting journal entries, and that's a major topic in this chapter. And we are going to divide them into two different types. We are going to have deferrals, sometimes also referred to as prepayments, and we're going to have accruals. So let's talk about deferrals first. I'm going to just pause this for just a moment. Okay, so in deferrals and the prepayments, what I like to talk about here is that we either have, we have revenues that have been collected or received, but not earned. And we can also have expenses that have been paid, but not incurred. So in our earlier chapter, what happened was when we had revenues that we collected, but we hadn't earned them yet, we recorded those as a liability, unearned revenue. When we paid an expense that hasn't been incurred yet, we recorded an asset. It was usually called prepaid expense. So it could be prepaid insurance, prepaid rent, prepaid, we also have supplies. Supplies would fall under here. So what happens is in our accounting cycle, when we are identifying transactions, these have already been recorded with the cash, but we're recording a liability and we're recording an asset because the revenues have been collected, but we haven't provided the services yet, so it hasn't been earned. Or we paid the expenses, but we haven't actually incurred the expenses yet. We prepaid them. That's why these are often called prepayments. So what happens here? Let's take revenues first. Let's say that I have a landscaping company. Actually, let's make it a subscription company. Let's say it's a magazine subscription, and I sell subscriptions. And once a month, I send magazines to my subscription holders. So let's say I sell 12 months worth of magazines for, let's say, $60. Okay. So let's say that during the month of January, I sold 10 subscriptions for, what did I say, $60 each. And for that, I will provide a monthly magazine. Now I'm using small numbers here, but it doesn't really matter. The concept's the same. So, in January, let's say I collected that on January 1. So I sold 10 subscriptions at $60 each. So I collected $600. So in January, when I collected that on January 1st, my journal entry looks like this. I debit cash because I have my customers' cash. And I credit a liability. Crediting a liability makes it go up, and we call that liability unearned revenue. Even though it has the word revenue in it, it is not a revenue because it's unearned, it's a liability. Okay, that's what we call it, unearned revenue, to record 12-month magazine subscription sold. Okay, so now we're providing a financial statement here as of 1/31. So the month of January needs to include all of the revenue that I've earned in January. Well, let's say that I sent one magazine in the month of January. So this is the subject of the prior chapter. We already learned how to record this type of transaction. But in this chapter, when we're talking about adjusting journal entries, then we have not recognized any revenue. We only recognize the liability. But when we've sent one magazine to all of these customers, then we have actually earned 1/12 of the revenue because we have provided the magazine for 1 month. So we have actually earned some. It's not all unearned anymore. Some of it's been earned. So we have this liability here, unearned revenue, and it has a credit balance in it of $600. Yes? And that happens to be the normal balance of a liability, a credit. So it has a credit balance of $600. But as of the end of January, we don't owe $600 worth of magazines anymore. We've earned 1 month. So we've earned 1/12. So on 1/31, we have to do an adjusting journal entry to show that we've recognized or need to recognize revenue for the month of January. So we had 10 magazines, and actually, let's do it this way. Hang on just a sec. Okay, so there are a number of ways actually you could calculate this. And so if you see it another way and come up with the same answer, it's totally fine. But what I'm going to say is, look, each subscription I'm selling, I'm selling for $60, and I'm providing 12 monthly magazines. So each magazine that I send, I'm going to earn $5 worth of revenue. And I sent those to 10 customers, and so that's $50. You could have also taken the $600, the total from above, and divided that by 12 months, and that would have come to the same $50. So either was fine. So this $50 is no longer a liability because I have provided the magazine, and so therefore I have earned the revenue. So I need to reduce this liability and show that I have earned revenue. So on 1/31, my journal entry is going to look like this. I'm going to reduce my unearned revenue by debiting it. Debiting a liability makes it go down. And I'm going to credit my subscription revenue. Crediting a revenue makes it go up. So I've now recognized that revenue to record subscription revenue for January. Now what happens is I have now recognized $50 of my revenue in the month of January. Okay, so so that's the idea behind the prepayments when we're talking about revenues. Revenues, initially we had revenues that were collected but not yet earned. And then why do we have an adjusting journal entry? Because we have to show that we have now earned some of it. So these calculations, you're really just going to have to be logical. And sometimes, I mean, it can be subscriptions. Sometimes it could be, the problem you could get could be an attorney who collects a retainer in advance, and maybe they tell you now, you've earned 40% of that retainer that you collected in advance. And the journal entry would be the same. You're still going to debit unearned revenue, and you're going to credit, in that case, legal fees earned, but it'll be a revenue account. But the calculation will be a little different. So don't think that, you're only going to see, something that is, subscription based. So it's anytime we've collected money in advance, but we haven't earned it, we record the liability at that point in time. And then as we provide the good or services, then we have to reduce the liability and recognize the revenue. Okay. So that's one prepayment. That's this first one, revenues that have been collected but not earned. So let's talk about expenses that have been paid but not incurred. So I have some other videos where I give you examples of these and how to record and account for them. But again, let's just say that that our company paid for 6 months. Well, let's change our color. Let's make it purple. So we paid for 6 months of rent in advance. We got a better deal if we paid for 6 months up front. So we paid $6,000 on January 1 for 6 months of rent. So what we know from our prior chapter, when we're recording transactions, we have to record this transaction on 1/1. So what did we do on 1/1? We debited an asset account called prepaid rent. And prepaid rent is an asset account. Debiting it makes it increase. And we credited cash. Cash is an asset account. Crediting it makes it decrease, right? To record 6 months of rent paid in advance. Okay, so that's what happened in the first part of the accounting cycle when we identified transactions and journalized them. But now, once again, here we are. It's January 31st, and we need to prepare financial statements. The question is, do we have all of our revenues and expenses for January recorded? Well, we haven't recorded an adjustment for this rent because now we paid that on January 1, but it's not all prepaid any longer. So we have this prepaid rent. It's an asset account, and it has a balance in it of $6,000. And here's where we debited it $6,000. So it has a balance in it of $6,000. But once we have we've used that, let's say it was for a warehouse. Once we've used that warehouse for the month of January, all of that asset doesn't exist anymore. So we had $6,000 and we rented it for 6 months. So that's $1,000 a month. If we don't make an adjusting journal entry, we're not recording any expense for the month of January, any rent expense. And we're showing we have an asset that has a value of $6,000. Well, it doesn't. At the end of January, it doesn't have a value of $6,000 anymore because we used that facility for 1 month. It's only prepaid for the next 5 months now. So what we have to do is reduce this asset by $1,000. So it only has a balance of $5,000. Now, at the end of January, it has 5 months prepaid because we've used the facility for 1 month. So on 1/31, what we're going to do is recognize that we have rent expense for $1,000. And we are going to credit our prepaid rent, our asset, by $1,000, make it go down. So our rent expense increased and our asset decreased to record January rent. Another way to say this is that this prepaid rent account, what we're doing is we're moving $1,000 from the asset and we're moving it to our expense. So we're taking it out of the asset and moving it down into our expense. And our balance of our asset is now only 5,000, and the balance of our expense is 1,000. So you can see this is super, super important, because if you don't make these adjusting journal entries, then your financial statements aren't correct. If you didn't make this adjusting journal entry, your assets would be too high. You would show prepaid rent of 6,000. So that would be, your assets would be too high, and you will not have shown this rent expense, which means if rent expense is too low, if you didn't recognize it, then net income is too high. If net income is too high, we close net income to retained earnings would be too high. If retained earnings is too high, owner's equity is too high. So you are going to have to know not only the adjusting journal entry that you need to make, but you really need to be able to figure out what will be incorrect in our financial statements if we don't make the adjusting entries. Also, really, really super important to recognize. I do not have a red pen here. Isn't that interesting? So I'm going to use just a colored pen here, multicolored pen, I'm going to say. Notice, I want you to pay attention to the fact that up here, this was our adjusting journal entry. We debited a liability, made it go down, and we credited a revenue and made it go up. Notice that our unearned revenue is a liability which shows on our balance sheet. Our subscription revenue is a revenue that shows on our income statement. Every adjusting journal entry you will do will involve at least one balance sheet and one income statement account. Okay, so it'll be either an asset and a liability on the balance sheet, or a revenue or expense on the income statement. So here it was a liability and a revenue. Now, if we look down here at our adjusting journal entry down here, our adjusting journal entry, we debited an expense and made it go up, and we credited an asset and made it go down. So our rent expense is on our income statement, and we made our expenses go up, and our prepaid rent is an asset that appears on our balance sheet, and we made it go down. So once again, it affected at least one income statement and one balance sheet account, and that will be the case for every adjusting journal entry that you do. You better be affecting one income statement and one balance sheet account. If you're using two balance sheet accounts, and what am I talking about balance sheet accounts? I'm talking about assets and liabilities. And when I'm talking about income statement accounts, I'm talking about revenues and expenses. So if you are making one asset go down and another asset go up, that's not an adjusting journal entry. Okay, it involves your income statement and your balance sheet. And if you forget to do them, then your income statement and your balance sheet are both misstated. Okay, they're both incorrect. All right, so I'm going to pause this here for a moment and go up to our accruals, excuse me, and get ready to talk about those for a moment. Okay, so let's talk about accruals. So we just finished lecturing on deferrals, and so let's talk about accruals. So accruals are, let's put them in something other than, let's put them in green. Accruals, if we're talking about revenues, there are revenues that have been earned but not collected. If we're talking about expenses, we have expenses that have been incurred but not paid. Okay, so these are very different than our prepayments, because in this case, we've over here in our prepayments, we've had cash and recognized a liability or an asset that we needed to adjust. But over here in our accruals, we've actually had revenue that we've earned or expenses that we've incurred, and but no cash has changed hands. So, so if it has been earned, then we're going to have to record it and recognize it. If expenses have been incurred, then we need to recognize it and show the expense. So once again, we would be doing, let's put it over here. We are completing a financial statement as of the end of the month, and we need to make sure this month of January has all of our revenue that we've earned, regardless of when we collect the cash, and it needs to have all of our expenses incurred regardless of when we pay them. So accruals allow us to recognize a revenue or an expense in the month that we've earned it, even though we didn't get paid. So let's just talk about a revenue that has been earned but not collected. Let's say that you have money on deposit at the bank, and the bank is, you've had money on deposit all month long for January, and on February 1st or February 2nd, the bank is going to pay you the interest that you earned for January by having money on deposit. And let's say they're going to pay you $486 for the money that the interest that you earned on the money you had on deposit at the bank for the month of January. They're not going to pay that to you until sometime in February. So my question is always to students, you know, how about if we just wait until February to recognize that revenue when we actually receive it? The answer is, oh, no. Of course, we can't do that because we use the accrual basis of accounting, which means we need to recognize revenue when they have been earned. And since I had the money on deposit in January, I need to earn that revenue and show it, $486. I need to show that revenue in January when I earned it, not February when I collect it. Okay, so how do I do that? Adjusting journal entries. It's a little bit of magic. So once again, I'm going to date the journal entry 1/31. That gets it back into January. And I'm going to recognize the revenue. So I'm going to call this interest income or interest revenue. I'm going to call it interest income. Let's put our debits and our credits. I'm going to credit interest income for $486. Why? Because crediting a revenue account makes it increase. So I'm recognizing that revenue by crediting interest income, but I haven't collected it yet. So I have a receivable, interest receivable for $486 to record interest earned in January. Now, by dating this journal entry 1/31, I now have recognized that revenue, and I'm going to report it on my income statement. Let's just take a look at the accounts that we used. We had a receivable and we had an income account. Where do these things appear? Our interest receivable is an asset that's on our balance sheet. Our interest income is a revenue account that appears on our income statement. So just like I told you with our deferrals and prepayments, they are adjusting journal entries, and this is an adjusting journal entry dated at the end of January, involves at least one balance sheet account and one income statement account. And if we don't make this adjusting journal entry, our assets are misstated, they're understated, and our interest income is understated. If our interest income is understated, that means our net income is understated. Net income gets closed to retained earnings, so retained earnings is understated. If retained earnings is understating, that's part of owner's equity. So our owner's equity would be understated as well. So it is important to be able to follow those adjustments through. All right. Now, I'm just going to briefly, I have better videos where I really do more robust problems, but let's just talk about what happens when we actually collect that interest income. Let's say we collected it on February 2nd. So on February 2nd, we're collecting it. We've already recognized the revenue, the interest income. I did that in January, so I'm not going to recognize interest income again. I am going to get the cash. The bank is going to put it in my account. So I'm going to debit cash and make it go up, but I'm not going to credit interest income in February because I showed it all in January. So instead, I'm going to credit this interest receivable account and make it go down. Crediting an asset makes it decrease to record collection of January's interest. And again, I have my receivable account here, interest receivable. I debited it $486 on 1/31 and I made it go up. And then when I collected the cash, I credited it on 2/2 and the balance is now 0. The bank does not owe me any more interest for January. Okay, good. So that's one. Accruals are actually pretty easy to understand, I think. So this was this accrual up here, revenues that have been earned but not collected. And so let's talk about expenses that have been incurred but not paid. So let's just say the most common one would be employees that work for us. So let's just say, once again, here's my timeline, right? We like these timelines. So on 1/31, I'm going to issue financial statements, but the last time my employees have been paid was on January 25th, but they worked on the 26th, the 27th, the 28th, the 29th, and the 30th. They worked 5 days that they have not been paid for. So 5 days, and let's say they earn together $1,000 a day. So we have $5,000 worth of expense because they worked in January. This was 1/26 to 1/30. They worked in January. When are they going to get paid? On payday in February. So the question I always ask is, you know what? How about if we just wait till February to recognize the expense when we pay it? The answer I should always get from students is no, we can't do that. We recognize revenue. We recognize revenue, yes, when it's earned, and expenses when they're incurred. We have incurred this $5,000 of expenses because our employees worked. They worked in January. It doesn't matter that they're going to get paid in February. We need to show that expense in January, or our January expenses will be understated. So our journal entry, what we're going to do is date it 1/31, so we get it back in January, and we are going to debit the expense. Let's call it salaries and wages expense. Debiting an expense makes it increase. And we owe that money to our employees, right? So they haven't been paid yet. So let's call it salaries and wages payable. Be very, very careful. Don't just say salaries and wages, because in one case it's an expense and in the other case it's a liability. So crediting a liability makes it increase to record salaries incurred but unpaid for January. Okay, so once again, we have debited an expense, making it go up, and we have credited a liability, making it go up. Where do these things appear? Our expense goes on our income statement. We've now increased our expenses, and our liability goes on our balance sheet. So once again, our adjusting journal entries have affected both an income statement and a balance sheet account, and they always will. So that is your lecture on accruals and deferrals in a nutshell. And then, I couldn't possibly give you every single scenario where we would have a prepayment and an accrual, because it can be anything, right? If you have incurred the expense but you haven't paid it, you need to record it. If you have earned revenue and you haven't received it, you need to record the revenue. So I can throw 1,000 different scenarios at you. What you need to do is to take a look at how I describe these things up here and make sure, the most important thing is to make sure that when you issue those financial statements, whatever date this is, that this period, because of the period assumption, this period includes all revenues earned and all expenses incurred. Has nothing to do with cash. So if you keep that in mind, you can't go wrong. So after this video, I just have just a couple of scenarios where I just kind of work through the adjusting journal entry. And so again, I can't give you every possible scenario, but I picked some select common scenarios that you will definitely need to work with in this course. So thanks for watching, and I hope this helped make some sense out of accrual accounting and adjusting journal entries. Thanks for watching.